All right, so welcome to Game Plan Sunday. Today's date is May 19, 2019, and we're here with another Game Plan session. We're going to actually take a review of what occurred over the past week. Then we'll take a look at the current market environment. We'll also take a look at events that are coming in the near future, and then this will help us to put together a strategy for this week in the market of, pinpoint where we want to make money at and mitigate risk. So, we'll just take a look at there. We'll start from there. So basically, and again, I'm just coming back from vacation, chilling with the fam. But over the past 2 weeks, I would say, because I got to go back before, there was the whole issue with China and the U.S. When we talked about this, this is a development we've been talking about for quite some time. And every week it was just basically trade deals are going good with China. Trade deals with U.S. and China is going great. It's going great. Everything is going good. This is how you know it's a bunch of people that's just lying out here. So that was a situation where we was actually taking a look at the markets, knew that the risk was there, but it just seemed like the markets didn't care. So it was like, okay, let's scratch China off because any news in regards to China is just fluff. The markets do not even care right now. But the poop hit the fan. Well, I guess Trump just got impatient with it, and he was just like, man, F it. I'm just going to go ahead and increase these tariffs on you guys. I think it was like $200 billion of goods that they actually increased the tariffs from 10% to 25%. So that's a huge margin there, okay? And the markets just was not having that, okay? The whole time, everybody's like thinking, oh, things are going smooth. It's going smooth. Now, all of a sudden, you get a tweet, and the poop hits the fan. So we went from there to China retaliating. That was us going to last week with China, posing their retaliation on like $60 billion of goods in response to like, hey, we could do this too. Right. And so, yeah, we're like literally in the midst of a trade war. And I think that everybody knows that. Now, this has an impact on the markets. And so, being that we're in the markets, it's important that we actually pay attention to that. And but it's a lot of noise. And so we would just want to make sure that we're, paying attention to what's driving the markets. And when we take a look at what's driving the market right now, it's a bunch of news. News is driving the markets. It's not really the normal, things like, economic, information, basically. This is really news, and it's a dangerous situation when the news is driving the markets because, any given day, it could be a tweet here and there and it just mess up your whole setup. Now, that's not the norm, but that's just what you have to deal with right now. So, but that's, a particular risk that's, weaving in and out of the markets. And I think it's going to stay here. I think it's going to stay here. It's just going to be like this way. But when we take a look at, the markets from a economic perspective. Let me actually pull up our handy dandy yield curve chart for you guys that were not in the class. We'll pull it over here. See if I can get this thing to operate. So if you guys go to our website, which is wallstreetjackboys.com, you can type in wallstreetjackboys.com/treasury, and it'll just pre-fill in it for you. You can pull this up any given day, and you can conduct your own research. And I really, really love this tool. I love the fact that I took the time to create it because in the midst of my research, I couldn't find anybody that actually had a tool so that we can actually a graphical representation of this yield curve development so that you can, basically understand it. You hear about it all the time, heard about it for years, just didn't quite fully understand it. But when you can see it, everything starts to make sense. So this was something that just basically, when we talked about this in our course, we had a 2-hour course, and it's basically about the yield curve. And it's important that you understand the yield curve because this is the leading indicator for a recession. All right. The yield curve is a leading indicator. So anytime we have an inversion on the yield curve, there's going to be a recession, basically. OK. And this is something that we've been eyeing here at Wall Street Jack Boys. And, again, we put together a beautiful class, about 2 hours long. So if you haven't subscribed, make sure you subscribe at wallstreetjackboys.com so you can get this information. But the importance, and I see you guys on Facebook. Thank you guys for logging in. Make sure you share this post and so somebody can get this information for free. OK, But yeah, once you actually get the courses, you get the class, and you understand how to read this information. And I actually created this here on our website, the yield curve, so you guys can check on it any given time of the day. You can actually conduct your own research and manipulate the numbers as you choose. Okay, you can take a look at, and again, these are bonds. These are U.S. Treasury bonds. This is, safety when you think about, asset classes. We think about this is the safest classes out here. So you can, whatever that you're actually conducting your research on, you can actually click in and click out. So I made the chart basically in a way that you guys can interact with it, to conduct whatever it is that you're doing. Okay. So what it is that we actually want to pay attention to on this chart is, let me actually pull up. All right. So what we want to pay attention to on this chart is basically, and this is two charts. And it's the same thing, but basically just a different view to look at it. Okay. I like both of these views. This is the view up here at the top. Let me actually change my annotation to a red color. All right. So we can actually, you can take a look at it from this view, or you can take a look at it from this view. Okay. You can actually also hit these dates to go back in time to see what we're talking about. Okay. In the past. Remember, every time the yield curve inverts, there's a recession that follows. Remember that. Okay. All right. So this is an interesting development. Basically, what we want to pay attention to here on our chart, and what I'm going to do is, all right, there we go. I'll pull it down some so we can see the bottom chart. We're going to pay attention to this bottom chart here. Okay. And this bottom chart, it's easy to understand. When we're looking at, when you're reading this chart, you want to pay attention to the time, the maturities of the bonds. Okay. So just think about it this way. If I loan you money and you got to pay me back this week, okay, that's just not much risk. But if I got to wait for you to pay me back over time, that's much more risk. So therefore, I deserve a bigger reward. So, on these charts down here, we got from 1 month, 3 months, 6 months, 1 year. As you see, the time is going further and further. And remember, bonds is basically the government borrow money so that the government can fund whatever programs that the government want to do. Okay. But basically, anybody can give the government money. You buy these bonds, and then you earn some, you make a yield. You make a return from lending your money to the government. And the majority of the people who actually buy these things are countries like China, who we're actually beefing with, right? And so China, they're like the biggest bond holder. They buy a lot of our treasuries. But anyway, what we want to pay attention to on this thing here is our short-term rates. And again, we'll just pay attention to the 3 month. Okay. Most of the Fed banks, they pay attention to this 3 month and the 10-year. Okay. So this is short term, and this is long term. Okay. So remember, long term, if you lend the government your money for a longer period of time, you're supposed to get a bigger reward. That's your yield. So anybody loaning money to the government, which you do that by buying bonds, you expect to make more money on your money. Okay, make more money on your money. What happens is when the short term, which we got this here, when that goes higher than the long term, then you get what you call an inversion. This is not how it's supposed to be. Okay, that means that people are not that secure in the government ability to be able to pay them back over this time, basically. Okay. So anytime you see short term, remember, higher than the long term, then you have an inversion. You have a weakening of the economy. That means the economy is contracting, is weakening. And when it actually inverts, it's going to be a recession. Okay. This is the most accurate tool that's available. And again, I don't know anybody else that's talking about it the way that I talk about it. I think it's important. And I took the time to build this stuff so you guys can see it because I'm a very visual person. So hopefully you guys can find that, this pretty rewarding. But I'm going to show you also why it's important. Okay. Now, as you guys see here, this here, the gray, again, this is telling you 3 months short term and the blue long term. Okay. See that? These are supposed to be wide. They're not supposed to be close to touching each other. Okay. But when they touch and they cross over, okay, like this, that's an inversion. All right. So we got that inversion back in March. Okay. Back in March. Okay. Now, when this happened, all the big investors, people that know money, they were like, yo, the ish is going to hit the fan. Everybody was like, yo, it was all over. Everybody was talking about it. And then next thing you know, it was like, they started reporting that, oh, it's going to be fine. It's going to be okay. You know, it's just whatever, you know, just to throw people off the media because it caught fire too quick. And that wasn't, you know, that's not what, you know, what people wanted to see. Right. And so it's like, yo, y'all got to fix it. You know, put the news headlines out there to get people distracted. So when they get it distracted, you know, it inevitably comes back up. OK. But once we hit these levels, this is unsustainable. This is just a part of the economic cycle. It has to run its course because it's about money supply. You don't understand. It's about interest rates and money. And who controls that? The Feds. They control that. OK. So last week was interesting because while I was out on vacation, we saw, boom, that inversion happened again. OK. So this is a second confirmation signal. All right. This is the first one. OK. This is the second one. You cannot ignore this. OK. This is something that, again, the only thing is that we don't know is the timing, but it has to happen because it's a part of the economic cycle. OK. There's a lot of manipulation that to occur that may try to thwart it. The Feds are already talking about doing, you know, things that are unorthodox to try to, you know, stimulate the economy or to land the economy softly and then to re-stimulate it. But the problem is they normally need 5 points for this interest rates. And the interest rates are already so low from, you know, when Obama had the economy, basically, they put it all the way down to 0, push it up to 2, but they really don't have enough for this thing to come down. OK. And so that's going to be some things that you guys may hear in the headlines. OK. But just understand that the Feds control the short part of this. OK. And then the markets basically control this part, the backside. And this is where we get the inversion part. And the Feds, they have like a little knob here and they say, hey, we're going to take this part here and we're going to drive it up or down. OK. And this is what gives us the shape of the yield curve. That's the curve of the yield curve supposed to have this shape. That's like the normal yield curve. OK. And then when you get into and again, this is because short term, lower, long term, higher reward here at the end. Then it starts to flatten out, which that's what kind of where we are now, starts to flatten out, flatten, and then you get that. OK, then you know, you're definitely in a recession. OK, so anyhow, I just wanted to point that out to you guys because this is what occurred last week. Now, hopefully my charts will cooperate with me here. I'm going to take you guys back in time. We'll go back in 2006. And again, you guys can, you know, use this chart on your own time. It's on our website, wallstreetjackboys.com/treasury yield curve. You see that up here at the top. And I'll make sure to just post that for you guys if you don't have it, or somebody can post it on Facebook maybe. So if we take a look in 2006, now this is before the Great Recession that we had in 2008. OK. And I'm sure anybody that's here did not know about this stuff. But so today, hopefully you learn something new. OK, the yield curve, you see it start dancing. OK, see that short term, all this crossing, that's the inversions. OK, those are the first signals. And it was 2 years before it occurred. And they knew it. You didn't know it, though. You and I, we didn't know it, but they knew it. OK, 2007. Same thing. You see it dancing again. See this crossing. This is not supposed to be crossing. I'm going to show you what a normal curve is supposed to look like, OK? You know, through the economic cycle. When they're touching, they're not supposed to be touching like this, OK? Or crossing. That lets them know to gear up for the recession, OK? And in 2008, you guys get the recession. As you see, the Feds drove the interest rates. You remember I told you the Feds control the short term, and they put it all the way down to 0, OK? They put it all the way down to 0. And you see the width between these. You see, they're not supposed to touch. Now the Fed control, now this is manipulation because that's what the Feds do. So they control the economic cycles. Okay, they give you your recessions and they give you your bull markets. So anyhow, you go to 2009 and you see that it's still, you see how wide it is. Okay, interest rates is 0. So the cost to do business, the cost to borrow money is risk free. It's risk free, 0. So you might as well rack up, you know, and this is what encourages the growth of the economy because corporations, people, everybody can get money from the government. You know, you can get credit basically. And that credit is what causes the economy to expand And this is why you have your cycle. So it expands and expands, basically, then it gets a bubble. So I'm gonna just fast forward it because I just want you guys to see what the, a healthy economy looks like. When I say healthy, meaning that it's expanding, it's growing, okay? When you're looking at the economy, it looks basically these yields, they are far apart from each other, okay? They do not touch, okay? So, and as we get to 2018, we got really close in December, and actually, I think there was some inversion there in December, but that was a different maturities. I'm not going to go through that. I just want you to see. Here we go again. We're back at the end of the bull cycle, and then we see these lines dance with each other. Inevitably, the course has to run its cycle, and there should be a recession, basically. Okay. So anyhow, just want to show you guys that, and plus, let me also show you. Let's see if I can pull up. These guys have one. No, I don't want to see that. Let's go to recession tool. All right. No, that's not what I want to see. It's not recession tool. It's going to be interest rate. Let me see. FedWatch tool, this thing right here. I think this is it. Here we go. So if you go to the CME website, they have this FedWatch tool. Okay. And we're not accepting no cookies or nothing. I just want to show you guys that this is already priced into the markets. Okay. These guys are the guys who, create the markets basically. And they have probabilities of what the Feds are going to do. Okay. So in this probability tool here, and again, I told you the Feds control the economy by changing interest rates. And so everybody's betting on, some time in the future, which will, these dates will indicate time. And these are the different time stamps. We got September coming, we got July coming up, we got June coming up, July, September, October, December, and then they got 2020 coming up. And these are the rates for the interest rates. And this is where we currently are right now. Okay. So we're currently here on the Feds. Again, they have been, on pause with the interest rates. That's been their whole thing is, hey, we're just going to sit here and watch because we're in a very compromising position right now. They don't know what to do right now because they scared. They don't know what's going to happen. They don't really want to bring the recession on or whatever the case may be. However, they had to do something once this thing hits, starts to unfold. Okay. So there was there's 90% chance in June, okay, it's a month from now, the Feds are not going to do nothing. And as you guys see, July, they're not going to do anything. But September, we're 50% chance here. So there's, a lot of people talking and speculating that September, they're going to have to cut the rates. Okay. Now, right now, the probabilities are not quite there yet. But there are events that will happen that will actually make this happen, make it come to pass, right? So September, you got a lot of big wigs that's, banking on the Feds to cut the interest rates, okay, here, because the economy is, the economy is going to be going into this recession, and their goal is to try to land it softly so they can start to drop the interest rates, okay? So they're banking on September and October. You see, it's pretty neck and neck. Again, this is where the cut comes in here. We get that 41.8%. It's like, okay, this can change by the day. Okay, this is really close, 41.8 versus 42.2. So by October, we probably more than likely will get the Feds to cut the interest rates. By December, as you see, everybody's already telling you there's going to be a cut. Okay, January, there's going to be a cut. You see how the numbers, the probabilities are higher here. Okay. So anyhow, you guys can check that out on your own if you're doing research, but this gives you insight into the future. So that may help you guys navigate, whatever it is that you do. All right. So back to our markets here. All right, cool. So this week, the whole issue with U.S. and China is a major thing. This could actually boil over and be the story behind the cause of the recession to come. Okay. A lot of companies are in bed with China, meaning that they do business with China. And if you ever, if you're in business, if you have products, it's always cheaper for you to get it from China. I mean, that's just the way the market is set up. Okay. So the thing is that through these tariff wars, the consumers like you guys and us, all of us, we're going to pay for it. You know what I'm saying? Because the cost of your goods are going to go up because corporations are in a whole different game. The corporations in the game of efficiency. And they're in the game of driving profits and revenue. They will not absorb the cost hikes. They're going to pass it on to consumers. And when they pass these costs on to consumers, that means you and I, us in the matrix, when they pass these costs on to us, our dollar, is not worth the same. So you have inflation that starts to eat away your dollar. OK, and that is an issue that could also cause a recession. Another thing would be the oil markets. And I'll just take a look at oil real quick. We're at 23. Okay. All right. So take a look at the oil market, and oil is very important because in order for you to get the goods that you need, corporations, companies, they have to get them shipped. They have to, ship it. So it takes oil, fuel to move things around. When these things go up again, corporations, they do not absorb these costs. They make sure they pass them on to you, and they make sure that they run their businesses as efficient as possible. OK, because they're in a different game than a race to survive. And so the way corporations run things, they got to, pass those costs on to you. Anyhow, as you see oil, you see back in the holiday season, so a lot of you guys, let me okay, here we go. If you guys can take a look here, our last highs here in oil. Okay, bingo. Back in like September, October timeframe. Okay. And they already know the holidays are coming and we need to keep the economy stimulated. We need to pour money into the economy. And a good way to do that is to reduce oil rates. Okay. Gas prices go down. You people go spending more money. That's the way it works. OK, now that you pour money into the economy, they're going to get that back up out of you. Bingo. Here we go. Oil markets. Very interesting situation here, because while I'm on vacation, I hear all this information and news about developments in Saudi and Iran basically beefing like cats and dogs. And the U.S. caught up in the middle to the fact that Trump basically was like, yo, we got to remove our diplomats because it's dangerous over in Iraq. And y'all know Saudi got the oil. OK, and basically, from my understanding, there was a drone strike that basically destroyed some oil tankers. And so when you have situations like that develops, the impact of it is that it impacts the economics of oil supply and demand, because what happens is the event occur. All right. So we get this flow. Now we see the stock charts. The stock charts make sense. I'm just giving you the story behind it. We read the charts because we're traders. And so this is what we do. We can clearly see this, that, and the third. We can clearly see what's going to happen. OK, but the story behind it, that's what drives it to what our charts are telling us. OK, so you get this point here. And then you get fighting, bombing, whatever they're doing to disrupt the supply of oil. And then what happens next? Oil prices are going up. So this is basically what I am anticipating for this coming week. We'll have to see how it unfolds. OK, but basically, as we just talked about these cycles, I'm sure you guys can see it. If anybody understands this, let me know that you guys understand it. Hit the like button, heart button, or just type in a Y. Just let me know that you understand where I am coming from. I'm not talking to myself here. Okay, so y'all got it. You can see the story. You can see the plot unfold. It's like a movie, right? Everybody always trying to guess the ending of the movie. Tonight we got Game of Thrones, the ending. What's the finale going to be? like the way that these things unfolded is probably going to end up this way, that way, or whatever way. This is kind of the same thing we're doing here. So because of the fighting and the hostility with Iran and also Venezuela, you got those issues there, which they were a huge oil producer. Okay, so you have supply issues, supply shortages in oil, which causes the prices to rise. We'll see how that plays out. We are at a key level of resistance, which is the 618, but I do believe that oil will be going up. Now, this is another factor that could also lead us into a recession, again, because those costs get passed on to you guys and inflation starts to eat away your dollar and you start to get a shrinkage in the economy through credit and stuff like that. So anyhow, take a look at that. And so we'll be paying attention to those developments this week. Now, let me take off this. Now, I think Justin, he came in the group for this past week, and I appreciate Justin whenever you see the video. Thank you for letting people to know to stick with the plan. When we had all this economic uncertainty, what I'm going to do is actually put the VIX for you guys. Yeah, so we pull up the VIX. And the VIX has been rocking. You guys can see the VIX is the fear indicator. Lets us know that there's fear or there is complacency. Okay. So when everybody get all complacent down here, like, oh yeah, the stock market going to the moon. Okay. Nothing ever goes to the moon. All right. Then we get that turnaround. The Fibonacci levels are already here. And we saw that, you know, it didn't clear this level. So then you get that, you know, reversal. It's coming back down here. And so we'll be watching for the VIX this week to see, you know, is it going to continue to breathe? It's already, you know, did all this, you know, very volatile move, but looks like it's trying to take a breather. OK, and so, you know, depending on if the VIX, you know, continue to relax, if the VIX relax, then we're going to play the stocks. OK, play the stocks alongside. Now, the interesting thing is that the indices, they all had the same pattern. They all got the same shape. Except for one of them, which is, I'll show you guys the, let's just look at the S&P 500. Try not to take you guys no longer. I know you got to watch a Game of Thrones, which I will be watching also. But, okay. So you guys can see this little setup here on the chart. Okay. The indices, this is what they look like. They roll over, they bounce off this 100. Okay. Now, I think that the topic of last week was basically the index is breaking the 50 moving average. OK, so this 50 moving average, this little pink line here, this is a key floor level. OK, now it breached this last week. OK, so investors were watching that and then it came down to this 100 moving average level. So that 100 moving average level is our new floor. As we see that it held, it did not breach. OK. And it's hugging the 50 again. So it's like came back up, but it's hugging this little pink line you see here on the charts. It's hugging this line. And so basically what you want to see in an ideal situation, you hope that the markets continue to move up, that we move past this and we come back up to test those highs again. Okay. Now we do have reason to believe that that's what happened. Okay. We have an up signal here. And we do see a shift in momentum starting to shift to the upside. Now, I'm not too convinced that it's actually going to go back up to those highs again. But what I do think is that we'll get a shift up here to this Fibonacci 618 retracement, which is about 2,900. OK. And then, you know, we'll get that resistance level. Trump may send a tweet or whatever the story may be. And then you get that rollover. OK. This is just what I believe. OK, again, this is not gospel. This is just, you know, we're taking the evidence and we're actually going to put this together. Now, this is something interesting. You guys, all the members, you already know your pattern setups. This pattern right here is a classic pattern setup. This is called a double top. It's a bearish move. OK, so basically it looks like an M. All right, has this top line as a resistance level and it can't clear it and it breaks. Goes into a bearish situation there. And then you get situations like this, which looks like a W, which is the inverse. and that's a bullish setup there. Okay. All right. So the reason I want to show you that is because I want to show you the same chart, but on a bigger time frame, which will be the weekly. And this is just big picture of the S&P 500s. Okay. And so what I'm seeing here is the shift in momentum is going down. All right. I do see that there's a shift in momentum. As you guys see here in the past, anytime you see that dark blue, it goes down like this. You see that? Anytime you see that dark blue, you see that? It's like clockwork. Boom. See that? It goes down. Okay. So we see that. But I'm also seeing this little pattern kind of situation like it's unfolding here. You know, it kind of looks like that double top on a bigger time frame. So anyhow, we'll see how that actually plays out. But that's something that, you know, I definitely will be watching. But I think that even right now as we speak, the markets are, you know, they're doing positive. You know, markets are doing good. Okay. Markets are doing good. Now, all the major markets look, you know, just the way that I just showed you guys here. The NASDAQ, the S&P 500, the Dow Jones, they all got the same pattern where it had this rollover, hit that 100 moving average and it's bouncing. So it's kind of like a bounce play. Okay. But the one that doesn't is the Russell. So I am a bit concerned with the Russell. I would like to actually look into the Russell for some short plays. Okay. And this is the reason why is because the Russell is struggling here at holding the 100 moving average. You see this? You see that line? It's struggling. It's actually under it. So it's under the 200. It's under all its moving averages. It's right there. And when it gets like this and it falls beneath here, that floor can become the ceiling. So I want to see if this floor becomes a ceiling. That'll be a great short opportunity. And if the Russell falls, then the rest of the indexes will follow it. Okay. Over my years of trading, I noticed that the Russell pretty much is like the leading indices. And so wherever the Russell goes, the rest of the markets kind of cycle afterwards. Okay. So anyhow, let me just come in here. Okay. So here we go. Yeah. So we want to see it clear, but it looks like it's struggling and I don't think it's going to make it out, but we'll see. We may get a little stall tomorrow. But again, this whole China situation, and you got these algos, these computers just doing all the trading. When they start triggering, you get massive sell-offs like what we got back in here. And so we're liable for another one of those to happen. Okay. So with that being said, all right, with that being said, we had played bonds. We were playing bonds past 2 weeks. As you guys see, bonds played out pretty nice for us here. Okay. Bonds have been up, and that's been really, really good. Really, really good. But they look like they're kind of topping out. Okay. We'll have to see how that plays out. Utilities is another flight to safety. This is something that, you know, again, when the markets are down, this one goes up. So, you know, if you get any downturn in the markets, utilities does have a squeeze set up here. It is an extended squeeze, which I don't like extended squeezes, but it's got upward, you know, trend, upward momentum. Had the buy trigger here, buy trigger here. We got the floor established there. We're pushing up against this resistance level again. And what you want to see is for this utilities to clear this level of resistance, which is this 127.2 extension. And the squeeze normally gives it enough fire, a little fireball for you, to explode through those resistant levels. Okay. So again, when you see this clear this level, then the squeeze is firing long and you get in this bad boy to the long side. Okay. You can play the individual names. You can go into the sectors and find, you know, individual names within this sector. Find the strength within the strength. The sector, the ETF itself is moves pretty slow. So if you want a little more volatility, just dial into the sector. If you know, I can always pull up other names in there. But that is one that I'm looking at right there. My pick blocking chart. Right. Let me tell you guys what else that I saw. The sector XLP, consumer staple sector. Okay. The consumer staple sector is basically in bullish mode. Let's wait for this thing to load up. Okay, so we see the consumer staples sector is actually still in bullish mode. It doesn't take a rocket scientist to look at this chart and see that, hey, this is doing really, really good. Okay. We do have some compression going on here, which is the squeeze. Okay. And then we have some uptrend here on the momentum here, buy trigger here. Now, key thing is this is a resistance level here. But I do have upward targets up here. So I see about $2 in movement we can get here with this sector. Okay. The squeeze fires long. Okay. And normally when the squeeze, as you guys can see in the past, the squeeze is right there. That was the squeeze, and you get that entry, and then you get that fire. Okay. Boom, fired long. So that's what we're actually anticipating on this. Okay. Now, that's if you're more conservative. If you want to take on a little more risk, you can dial into the actual individual names of the sector. Okay. And I think that what we have in this sector would be Philip Morris. Philip Morris is a name here for you cigarette smokers, which I don't smoke cigarettes. I do not advocate that, but hey, it is what it is. People gonna make money off of you smoking. So here we go. We got this floor right here. We got that buy trigger that was right there. We got the buy trigger right here. We got upward trend momentum. We got the squeeze right here. Okay. And so we want to see this lift up off the floor. We got a big target of 95.54. Second target will be basically $100. Okay. Also within this sector, we have Costco. So we got Costco, and Costco is off their new highs. Okay. This is interesting. Okay. You got that buy trigger that was right there. You got some upwards momentum here. You got the trend that's upwards. We got that squeeze. Okay. And basically the chart is bullish. And so we want to keep looking at it to the long side. Okay. And then we have basically upward target 255. I got what? Let me see, 251. We have to pull up how much this chart moves the volatility, but I'm basically looking at a good 255 to 260. Okay. If the squeeze fires long, then we're definitely looking at the 260 for it. And all of this could take shape before their earnings. So make sure the earnings are ahead. So you don't want to be holding on to this thing through earnings. You want to play it into earnings and get out of it. That lets you know that, hey, we'll get out of it on this date here, before this date happens. Okay. So ideally we want to see it rise up here. Boom. We exit here with the profits, and then let it do whatever it's going to do at the earnings, because you never know how those are. I'll do another one. I haven't quite finished looking at this sector, but I have seen this same setup in the telecommunication stocks. In the telecommunication stocks, I have seen this setup throughout, all the names there, same setup basically. So I imagine that they're going to move together. And Verizon, top on the list, we saw this floor, which is the 200 moving average. It held its floor. This floor is also, you see it crosses over with the 618 on the, Fibonacci. So that's a clear, strong level for the floor, which we know. We did get the buy trigger here. You see the little green arrow that says, hey, get in, get in, get in. Okay. And so if we look here on underline of this ticker, we got the trend that's going up. We also got the momentum that's going up. We have a squeeze that just started, forms 3 dots in. But what we would like to see this thing do is to first come up to this, $59 target and push through there to upside target up here. So that's what I like to the long side. And so we took a look at some short stuff. We took a look at some long stuff. I'm still trying to get into the flow of this thing, fresh from vacation. So you guys, if you have any questions or anything you guys want to look at, I'll go ahead and take a look at that now. And then we'll bring the session to a close so that I can go and catch Game of Thrones. You feel me? All right. And by the way, man, I did get a chance to check out that new John Wick. It was ill. I saw it in 4D. I don't know if y'all ever seen movies in 4D, but check your local theater. I think Regal Theaters, they do the 4DX. It was crazy. So anyhow, that was a awesome movie. The Avengers was also another awesome movie. It's long. It's like 3 hours long, though. Don't take your kids to go see that one. It's crazy. And don't take the kids to see John Wick. That's crazy, too. Okay. But yeah, do you guys have any stocks that you guys want to take a look at? Any names? Any questions in particular? Just trying to think anything else that I can think off the top. Oh yeah, another key thing is that y'all remember the situation with Huawei, right? That company. Well, Trump did issue a ban on them this past week, and y'all know we've been following this whole development since last year. Okay, if you go back to all the previous game plan sessions, we talked about all these different developments, and the whole situation with Huawei was, that was definitely a main one. We dropped the article on the website. If y'all go to WallStreetJackBoys.com, go check the blogs. They're free. We did one on 5G. It's called Get 5G or Die Trying. Really interesting article, but we actually go in and talk about basically how 5G is a major deal. Everybody's going to race towards it. You remember like America's whole thing with going to the moon. It's like, yo, we got to beat Russia to the moon. Well, that's the whole thing of the past. That propaganda is over. This new thing is we have to get 5G before China. Okay, that's what it's all about. And what's good, David? I see you. What's good, Marcy? What's good, Mel? What's good, Charles? Hey, everybody. But yeah, so basically the whole race is to get this 5G situation. And the government is all into it as well. So, again, whatever their agenda may be, I'm not going to get into the conspiracy, but just understand this is something they got to push. There's something they're going to push. It's not going away. It's going to change the way we do everything in life. It's going to have us always connected. Everybody will always be connected, no lag. And however the government benefits from that, I'll let y'all figure it out. NASA basically created the technology. But if you go read the article, you'll learn a lot from it. But the company Huawei, they're actually the leading company on the China side. And, Mike Pence, he went over last year and he basically threatened a lot of the European countries over there to not do business with them. It's like, yo, don't do business with them, because they're basically trying to pressure them, to not do business with them so that we can lead this whole thing. And Huawei is one of China's biggest companies. OK, so they're playing chess games, as you guys can see. It's a lot of posturing going on. You have Trump, you have President Xi. China's going to lead from a position of strength. Trump is also, leading the assault, for negotiations, basically. And this is just leverage. You're seeing a bunch of posturing. That's all it is. They're flexing. And this thing can drag out for the whole year, And in fact, I think that what China probably want to do is drag the whole thing out. I don't think they're going to make a deal. I think they're going to wait until elections 2020 to see if there would be a Democratic, president to arise, because if that happens, then they don't have to worry about the whole trade situation. And so, anybody that's following the development, just know that the way that China does business, they're hardcore. I did read a couple of articles about China basically comparing the situation with Japan when Japan's economy had bursted, and basically how, it was from the deal that they did for their currency. And China's been taking notes from that, saying that they're basically not going to be the next Japan. They're not going to let that happen, And so there's going to be casualties in this war. We have to see, how it's going to play. I would say that any company that has, lots of exposure in China, meaning that your goods are manufactured over there. I mean, just take a look at Apple. All right. Your goods are manufactured over in China. You have the biggest exposure, man. You have the biggest exposure. So you'll be the most risk, averse there. And so those will be companies that I'll be looking to short. Okay. But yeah, anyhow, so you guys, Mark, did you want to look at MasterCard? Okay, I'll take a look at that real quick. Okay, cool. My bad, my man. Didn't mean to skip out over there. Okay, so yeah, I like MasterCard. This is a bullish chart, obviously. Okay, we got these different floors here. Okay. Yeah, so basically, this is a bullish chart. We got our floors that's established here at the 127 right here. And we do see that is, I want to see it clear this 786 though. Okay. I want to see, because it looked like it may go sideways a little bit. I'm not too sure how it's going to play out. I wouldn't look to play it tomorrow. I'll be just watching to see how it's going to behave, where it's going to print. If it goes higher, if we start, you see it trending higher, then yeah, we go to the long side. But, I don't know. When they normally do this kind of situation, they sometimes drift sideways. It is in a squeeze, so you definitely want to keep it on the radar. Momentum is a little, neutral, but we do have a buy trigger that says, hey, buy. Okay. This one isn't really participating just yet, the trend. Okay. So this means that we may have some time to enter in on this one, but I do like it to the long side. Let's say it's about 260 target for the first level. Okay. But yeah, I do like that one to the long side. No worries. Okay. XLU, we just covered XLU. That was the utilities one. So we just covered that. Gold didn't do so well, and bonds may need to breathe a little bit. So that's the way I'm looking. That's my forecast for the week. With that being said, I go ahead and bring us to a close, man. You guys enjoy the rest of your weekend. We'll catch up through the week in the markets. If you know somebody who could benefit from what we do here at Wall Street Jap Boys, make sure you hit that share button and send them to the website, send them to any members. We'd love to welcome you guys to our community. And let's get